How about a market prediction? So the good news is, as I've stated, corporations are very healthy. And so we are on pace to earn in the S&P, call it $96 this year. Estimates have actually been rising a little bit. And so the next 12 months should produce a lot in corporate earnings. The other good news is the market's not expensive. And so if you look at trailing PE going back to 1995, or if you look at forward PE going back to 1995, again, this market's cheaper than it was in 1995. So if you liked it in 1995, before it went on a 5-year tear compounding at 20% a year, then you'll love it today. And so even with that spike lower in September where we got to the 12 PE, we really haven't gained much since then. I think the forward PE as of this morning is like 13.8. And so the market is not expensive. And so now it becomes a math exercise, okay? So if we take 15 to 16 kind of PE level, and we multiply that by, call it $90 to $100 in earnings, we can get a range of outcomes that's probably pretty predictable. And so I gave this presentation in Nashville last week, and we were at 1344 on the S&P, I think, when I gave it. Today we closed below that. But the bottom part of the range, if we're going to earn somewhere around 90 bucks and we're going to be multiplying it by 15, is about 1350. So a little bit above where we are today. Top of the range, in my judgment, let's say we get to 100 bucks next year, and we're getting close to that run rate unless something gets in the way, and I'll speak to that, and multiply it by 16, then you're at a 1,600 figure on the S&P. Split the difference, you're at 1,475. That's 12, 13% above where we closed today. Do with that what you will. The other thing I have to make mention of is the third year in a presidential cycle has always sort of been the sweet spot. And so if you look at it going back to 1900, in the third year, on average, the market appreciates 78% of the time and returns about 11.3%. You can goose those numbers up if you cut them going back to 1945, where the market appreciated 94% of the time in a presidential third year and actually appreciated by 17% on average. So third year should be good. You know, I wouldn't put money on that. I think the fundamentals matter, but it makes me feel better. In terms of our strategy, so it should be a good year in the markets. How are we going to improve upon that? So went back and looked at valuations on the planet. We've made a lot of money in the emerging markets, but you know what? The emerging markets have gotten kind of expensive. At least they had when I did this chart. Relative specifically to the United States. And the United States, as I'm demonstrating, is pretty strong. There's a lot of opportunity here, and it's historically pretty cheap. And so we actually sold some of our Asian holdings, which I'm glad we did, earlier in the year, and we rotated back towards the US. Our second strategy is to move towards larger companies. And so this chart, I'll make it easy. Small cap value stocks are basically selling for 99 cents on the dollar. Large cap growth stocks are basically selling for 69 cents on the dollar. Which one do you want? And so, you know, we haven't abandoned small caps, but we've been rotating the portfolio towards larger companies to take advantage of these valuation opportunities. Also, in the third year of a bull market, large companies tend to pull away. Returns get harder to come by, as you can see. It's amazing how close these numbers are to what we actually experienced. But anyway, so large companies in the third year tend to outperform. Again, I wouldn't bet the farm on it, but it makes me feel better about decisions.